Hello everyone. Today's a bit of a different episode. I need to make an objective opinion on all of the companies which I bought during periods when I didn't have enough investment knowledge, in my opinion, looking at my retrospective self, and to see whether I should own them or not. Are they still good companies or terrible investments I need to divest? This video might be a chance to fix it, so let's dive straight into it, as I think that based off this video, some of you watching might start to view your portfolios a bit differently. Maybe looking to switch over to other companies. Okay, so let's start off with Caterpillar, a company which is in the business of manufacturing heavy-duty machinery, industrial machinery, designed for excavating holes, moving heavy rocks around. They are used in mining and all of that. We can actually go down here and just look at this. They make natural gas engines, diesel, mining equipment, industrial gas turbines, multi-terrain loaders, excavators, motor graders, pipe layers, road reclaimers, tractors, loaders, telehandlers, and utility vehicles. So that is what they are doing. And I bought it for a very silly reason actually. I bought it because I once watched a James Bond movie and there I saw a Caterpillar excavator, a small one, into which James Bond entered, and he was fighting with it against some evil crook who was shooting at him. So I bought it because a day after I bought it, I started having second thoughts about it, specifically looking at their dividends, because at the time I was very much focused on the dividends. And so when I saw this chart that in 2020, which of course isn't anything bad inherently, I saw their dividend grow at 0%. Now, immediately the day after that, I started to question this whole investment and thought about selling it. And of course, after that time, it started growing. I of course bought in 23, so I wasn't impacted, but it just shows you that from the beginning I wasn't convinced, I think, of this company. Maybe not convinced, maybe I didn't research it enough. I didn't research it enough because I was surprised at this, so that was a bit of a stupid move from me. Apart from that, I haven't added more attention to it. After that, I thought, okay, let's just leave it because I'm a long-term investor. And so what happened was absolutely amazing. I completely detached myself from that position, and it soared a lot to exuberant price levels, and I was quite surprised. Happy but surprised, and that isn't a good sign when you're surprised. And so when we are looking at their financials, actually this company is on a bit of a stagnating phase. Their revenue is declining. and they are making less money overall. So I'm not really sure what to do. They are doing really big buybacks, implying that management is thinking about their stocks as being, valued at a valuation which isn't the best, And they don't make a whole lot of cash. Their profit margin was only 14%. Their free cash flow margin, so revenue left as is the percentage of revenue left as free cash flow. So the money that they can use. Now, is that really enough? I don't think so. There is something going on that I don't like. The revenue stagnating, they are saying that the same, that the yearly sales are going down. Now, I don't really know what to think of this company. As you know, they also own this merchandise segment, they sell those, maybe you sometimes see those bags with their logo, some hats, all sorts of things. But I think a more interesting aspect is that they are actively collaborating with NASA. And they want to, help NASA do stuff on the moon, such as, excavating lunar rocks, mining, autonomous control of vehicles. For example, here we have the CAT command remote console removes an operator from the cab and potentially hazardous job site conditions by controlling machines from a safe distance while allowing for line of sight operation of a machine. So like a remote controlled car, basically. That is what they are planning to do. They also have those big CAT 777C autonomous off-highway truck, and that is their first ever. So that was in 1996 actually. So you can see, it was actually a long time ago, And so they started back in 2007 with robotics and autonomy with NASA. So, there is something, there is a glimpse of hope for this company. They are doing lunar excavators. Most recently, NASA has been leveraging Caterpillar's proprietary simulation technology to develop its own robotic excavator. The in-situ pilot excavator, IPEX, will help build essential infrastructure on the moon as part of the Artemis mission. Okay. Now, the CAT logo on the garment was a moment of pride for them. So, will that be a significant contributor to their overall business? Well, maybe not as significant, but if we go into Market Vision, which is software that I developed, and it's part of the Substack membership, we can look at the summary of this company. Caterpillar has announced a landmark-inspired collection, which marks the company's 100 years of business. The news highlights both positive developments and ongoing challenges in the industry. The company is expected to maintain strong performance in the long term due to its strategic growth and solid financial position. Industry growth is projected to continue positively, driven by consumer demand and technological innovation. But of course, there are some risks with economic conditions and supply chain disruptions. Now, my AI here is giving a hold rating for this. They are saying it's a strong fundamentals and solid brand position. Yes, it has a solid brand position. As you know, I always go by some site in the city and I see Caterpillar. Oh, I'm an investor in this company and I feel a sense of pride in me when I look and see that there is a Caterpillar excavator near me. Now, whether I should think like that, I'm not really sure. maybe it's not the best thing to do, but they are expected, I can just pull up the forecast here. On an annual basis, they are expected around 5% revenue growth. So I will take that into consideration when doing my discounted cash flow analysis, as well as a different type one, a varied cash flow analysis. Okay, so 18,070 million, 35, so they have more debt than equity, so not the best, but it's positive, so it's not the end of the world. Yeah, so you have the profit margins here, so they keep up just a small bit of it, but compared to similar companies in the industry, they are actually doing great. Strong return on invested capital. They are above the median. This is the median, and they are above it significantly. CMI and TTC are some other two companies that we can look at. Now, the market share is calculated at around 27%. This is the company. And, the valuation for a 10-year period, we come to this conclusion. Whether that is correct or not, it's another thing. Benjamin Graham is, of course, out of place because it takes into account the earnings per share growth over the past year, which has been negative because, even though they have been doing buybacks, they didn't have that much. So now for the varied revenue. Now, based on all of this, we can just assume minus 2% revenue growth. As for this one, we will assume 5%. This is my varied cash flow analysis, so it's more like, dependent on your entries. So for example, we have 5 and 8, so let's just pick 5.8 here for the third year. And for other years, let's pick 5.7, 5.7. Let's maybe add, or maybe calculate for this. And intrinsic share price, in their opinion, in my opinion, is this amount, and this is the varied cash flow analysis. So that's for 5 years. Typically, when it's on a 5-year basis, it typically shows me an overvalued sign, so this is yellow then. But here we have it undervalued by about 27%. Now, whether that is correct or not, we will see in the future, but it's pretty stable. We can assume more negative scenarios, but I don't really see a total downgrade of this company. I have really no idea what will happen to this one, so I need to look at this, whether I will sell it or not. But yeah, that's this one. Let me know in the comments what you think. Now, the next company we will take a look at is Booking Holdings. While I love the company, I think the way I bought it isn't correct. I just watched some YouTube videos from time to time, as I like that. And there is this one YouTuber who told me about this company and how it dominates Europe, how it has, everything interconnected, flights, restaurants, hotels, It's great, I worked in McDonald's at the time when I bought this company, and I bought it only once, I bought it somewhere around here. I used the opportunity when I was in McDonald's to ask random people whether they would stay in bookings.com or Airbnb during their summer vacation. And the majority of the people said that they will use Booking, citing the fact that either they don't know what Airbnb is, they haven't heard of it, or B, they have some reasons not to like Airbnb. And so when I heard that, I got convinced and click, I bought them. Now, it proved to be a great decision, but was it really a great investment one? You know, they started paying dividends, which was great. As I'm a long-term investor and I like that. But you know, is it really a great company? Well, you know, let's actually see, because I haven't looked too deep into them, but you know, they have a reasonable payout ratio. Insiders have really small percentage of all the shares, 0.2%, so not good. Now the gross margin that they have is 87%. Remember that they are a software company mainly. So we have this, that is really good. The operating margin is high, 33% almost. Profit margin is 22%. So not bad for a software company. And we can actually see that the revenue growth on a yearly basis has been steadily increasing. If we look at the quarterly basis, it's, you know, it has period of higher demand and then lower, but you know, people will still go on vacations, you know. Of course, we have things like COVID, which could significantly impact their operations, but you know, people still are using you know, their software, you know, for going on vacations. So we'll see. But you know what my AI says? Quote, Booking Holdings has reported a 7.4% increase in shares since its last earnings report, indicating strong performance and positive sentiment from news sources. The company is currently experiencing positive sentiment and outperforms the Dow Jones, which suggests growth potential in the travel industry. Long-term investors should consider holding Booking, as it has demonstrated strong growth and outperformed the market. The stock may continue to outperform the Dow if there are positive economic trends and industry demand for travel services. There is possibility of continued growth in the travel sector, making Booking a strong investment opportunity. Okay, and it gives a recommendation of buy. The travel industry is expected to continue growing, making Booking a solid investment. Now, is it all that's, you know, great? Well, let's take a look at the stock data information to check it out for ourselves. If you don't believe me, of course. So let's wait for some few seconds. The next company will be Alcia, the tobacco one. So we'll go into that later. Okay, so now let's just see. They have negative net equity. They have negative net cash, so not good. But you know, when comparing their business to their competitors, no Airbnb listed here. Well, forgive me. My software sometimes doesn't do it. Wait, why is Amazon here? Okay, now it's better. Booking is here. So you know, they have a bit of market share. I don't think Netflix belongs here as well. So you know, they are a giant company. You know, Expedia is a competitor to them. We don't have Airbnb here. I don't know why. It's probably because of it couldn't find exactly Airbnb because it scrapes some data from many websites, all of that. Now, their valuation. Now, what are people saying? Well, the analysts saying about Booking. Well, they are expecting their revenue to grow by 8%. 8% next year, you can see. And so that is 10.85%, 8% fiscal year 26. So let's just assume 8% in my analysis here. 8% would make it worth $12,525 per share. Now, that is the discounted cash flow analysis, so it doesn't take into account the ebbs and flows of a company. So let's just assume that for the first year, 8%. 8%. Now for the second year, let's assume 7 maybe. Let's just assume a declining trend because it's more probable, and let's be more conservative. Now, the company might be overvalued by around 17.92%. Well, we can take a more balanced outlook, giving them some gaps, but generally positive outlook. Well, you can see it's still not there yet, so they would need to grow we would need more maybe years. So let's just say 8%. It's growing, now going down, then growing next, and growing. And so, it's still not there where it should be. Maybe it won't have those, growth weird spikes. Well, looking at this, it gives me 7 years, so I think we would need to input more time. So investors are pricing in some of their future growth. So I don't really know whether I should own it. Maybe it's a time to sell, but there is a good thing that reads: don't sell your winners too early. Many people make that mistake, unfortunately. Now, understand me, I don't want to become a trader, I just want to be a high quality investor. So, I need to make more, analysis on this company, as I'm not sure whether it's still a good bet because of the fact that I didn't research it too much, actually. That's what worries me. Now, I don't think it's a bad investment. It isn't. But, I need to find out the actual reason why I should still own it in the first place and present it to you guys so that I will be convinced of owning this company and not owning it because I bought by mistake. Okay, so that was Booking. We can now take a look at Altria, the company behind tobacco products. Now, this one is a more recent buy, and I bought it primarily for their huge dividends, which I know isn't the right mindset always. But I was tempted by their huge dividend yield, almost 7% yield, I really like that. And so right now, I need to take in a closer look at this company. What I like about them is that they are focused on the US. And, for some people that might be some sort of limitation. They might say, Anthony, you want a monopolistic company, right? Why not own Philip Morris? And actually, I made a weird mistake when I chose it over Philip Morris, because I saw that Altria actually spun off Philip Morris in 2008, the international one, of course. The US based one is still in their power. So, I thought that they are still in control of some shares of Philip Morris International. I think I misread an article somewhere when I looked at that. I'm not proud of that, I must say. I actually found about it today, so I was living in complete delusion. Or sorry, it wasn't 2008, it was 2007 when it was divested. So right now I have a stock which is in the positive, I didn't lose any money on that. I'm in the positive and I'm not quite sure what to do, I must tell you. Whether to own it or not. Some people might say it's not a good company to buy. Some people might say it is a good company to buy. Now, British American Tobacco is another company, but they're smaller companies and I want large established ones to have more safety margin. I like reducing the risk. Of course, I can't reduce risk entirely, but I like not having that. So, what does my AI say? They have a mix of positive and negative sentiment across different news sources. While some reports show strong institutional backing, others indicate potential market concerns. The company's price prediction suggests growth from 2.5 to 2.30, but they are concerned about dividend yields and stock performance. The outlook is mixed. Some analysts are predicting long-term growth and positive performance. There are concerns about dividend yields and stock valuation. The outlook is positive for long-term investors. Strong institutional backing and potential for growth could present an attractive long-term investment opportunity. There is a need for more clarity on the current market conditions and dividend yield to determine a definite outlook. And the recommendation is hold. Now, of course, this is made by AI, so don't listen to it. Make your own decisions, of course. Long-term investors can benefit from Altia's potential growth and institutional backing, and the stock could remain relevant even the market conditions allow for growth. Now, this is true, as Altria is in a bit of a pickle right now. They have declining or maybe stagnating revenue because it's all over the place. On an annual basis, it's going down. Here you can see it on our chart, not the best one. But they are actually making more money quarterly, sometimes on a quarterly basis, it looks like this, more money, then it's lower. So, I don't really know what is the issue here, but they have a strong gross margin, 72%, operating margin 61%. Now profit margin is 23%, but still pretty solid, I think. And if we look at their forecast, we don't see a rosy image. We see a company that is, a bit of a pickle, around 2% revenue growth. And some people might say, oh, this company isn't worth buying, why do you own it? And I myself have this opinion that, of course, cigarettes are bad for your health. As people will still smoke them. That's the truth. They become addicted to them. So, we are profiting from that in a way. Now, What I don't like about this company is its negative negative equity, and they have more debt than cash. And now, well, consumer defensive companies, here you have them. Philip Morris, well, it cut it off a bit here, but probably they have more. Sometimes the data fetching might make some mistakes, so it puts down 0 as a placeholder. Now, of course, don't look at those because they are in a beverage industry, which is totally different, but those are similar companies. Now, so they are showing pretty profitable growth. Well, maybe not profitable growth, sorry. Pretty large market share position, 7%. Not bad, but they are behind Philip Morris, the company that they spun off from themselves. So it's a bit funny, They were also the owners of Kraft Foods, So it was actually a really interesting company. They even owned 7-Up, I think, Benjamin Graham. Well, the earnings per share was positive. You can see it from this. Where is the earnings per share growth? You can see this. Earnings per share is still positive. I think mainly due to them doing buybacks, rather strong, 3% per year, really good. I like that. That I like. And so connected with the dividend yield of 7% almost, with 4% yield, 4% growth, that is some growth, I like this. But if we assume 2%, maybe, some ebbs and flows in the company, maybe we give them a little slower revenue growth. Still, it gives them this amount. Now, if we assume no growth whatsoever, or maybe even negative, still positive. So it could be some kind of an asymmetric bet. Look, I'm putting this down, but this stock is significantly undervalued, as you can see. Look, it's almost indestructible. Just what needs to happen so that this company would suffer? It's still undervalued. Still undervalued in terms of the free cash flow. So there is a light at the end of the tunnel. Of course, this company, it is a dominant player in the US, so that is one thing. But whether it's a good buy for long-term investors, some articles which I read today actually are saying that Philip Morris is more, of a stable one, because they have successfully transitioned into reduced risk products, or RRPs, which are safer, but not, of course, 100% safe, than regular cigarettes. So they have a proven model, while Ultra is a bit struggling. So I'll leave you guys with that. Hopefully you took something interesting out of this video. I'm currently not doing anything. I'm waiting for the money to arrive to my account, and I will make a purchase soon. So thank you very much for watching this video, and I will let you know soon what I'm going to do. Thank you very much. Goodbye.